Okay, so let me give you an example. Okay, let's say, for example, this is literally, I took a screenshot from the company, from one of the companies, how they explain insurable interest. Imagine you trying to understand this as my mom, or as English as second language, or as a part-time person trying to do it. It's just too many words, right? And it's just, and you have to read it probably multiple times to really understand what it means. So what if I presented to you insurable interest this way instead? I give you, hey, what makes sense? A son and a mom? What makes sense? A business partner, and an upline, downline that does not create insurable interest. Okay, that's an example. Second one, this is another, literally just a screenshot from the website or from the slides. I attended a few just to get an idea. And I basically found out that insurance companies or licensing companies has also not changed for 30 years. Okay, so, that's why it's very boring. So now this is the way that I explain the same information. It's exact same information, but first of all, do you really need to know every single bullet point to pass a test? No, you just need to know the main things. Maybe Kelly on the test, they might ask, hey, they might put out, what are some of the resources underwriters have access to? And they say all of them except. So you just need to remember, okay, these are the 5 ones that mainly they will ask about. So if they put on there, what is your religious background? Hey, I don't remember them have religious background. So you will pick that as as the answer, right? So I just wanted to give you an overview about kind of where this come from. But now let's officially get started with the licensing prep, okay? So now that you understand the background, the last comment I want to make is that while you're listening to this, first of all, if you're not licensed, I hope that this will really help you, get studying, help you understand the concepts faster so that you can take the test faster. Okay. And for anybody that's licensed, this is meant for that anybody can teach this. It doesn't have to be a high fancy instructor. You can be an MD, you can be an associate, you can be an SMD. You can do this in the office. You can do this at people's homes. Maybe, Jensen, you go to New York tomorrow and you decide to recruit 5 people in a group presentation, and you realize, oh my gosh, I gotta get these 5 people to pass a test right away. So when I come back, I can fast start them. So you say, hey, 5 people, let's sit down for a couple hours and let's go through some licensing concepts together. Okay, so before I begin, I want to kind of give you the background. Okay, number 1, you will find that it's a lot less information. It's less than what you find on the website. Because remember, I'm not an instructor, I'm a builder. Okay, so when you take the test long, I just want you to focus on understanding the concepts. Okay. And once you understand the concepts, then I feel very confident that you know how to answer the questions. Okay. So it's not going to every single detail because you don't know every single detail. They mainly want you to know how insurance works, what are the general compliance rules, stuff like that. Okay. And also I looked on the state licensing, and they will actually give you a breakdown of where most of the questions come from. Right? So most of the questions, for example, Vicky, comes from, they say like general insurance is a big amount, life insurance and health insurance is a big amount, but something, for example, like Medicare supplement is not a big amount. They only ask 1 or 2 questions. So why do we need to go into like 20 slides about Medicare supplement? We don't. Okay. So that's kind of how this slide is structured. And last but not least, I am the one that did the slide myself. And so you can imagine I kind of have quite a busy schedule. So right now I was able to finish life insurance. Okay. I have not completed, you will not see in here, is annuities and health insurance, but I do plan to work on that in the next 7 to 10 days and get that approved through compliance and then send out part 2. Okay, so I will say that this is part 1, but I think you can all agree with me by the end, you'll say something's better than nothing, right? And so if we can get people started first, that's great. And then just wait, in a couple weeks, I will get you part 2. All right. So everybody ready to get started? Okay. I love interaction. I'm going to call on your names a lot, and just be ready to type in the chat or unmute. It is about over 80 slides, so please anticipate that this will take me about an hour and a half to go through. I recommend that when you do this in person for your team, I recommend that you actually go slower than what I'm going to go through with you today, because today I'm just giving you an idea of the slides. But if you guys were my base shop, I would actually say, okay, hey, let's meet in person, give me 2 to 3 hours, and instead of just rushing through the slides, I would make sure before I move on, you guys can ask questions and we can give more examples. Does that make sense? Okay, so today when you just see me click, 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 it's not meant to be taught like that. I'm just doing that because of the setup today. We are on Zoom, so it's a little bit special. It's just to explain to you. But if you're in person, I think that you should be able to give a decent amount of time, because we're trying to help them study to pass. Make sense? Okay. So, all right, everybody, let's go ahead and get started. So once again, this is licensing prep just for life insurance, okay? And this, again, a disclaimer, just to make sure you all know, nothing here is specific advice on investment, legal, accounting, etc., and in no way trying to sell or solicit any financial product. This workshop is purely for educational purposes. I cannot guarantee that you're going to pass because of this, okay? It does not replace any licensing requirements in your state or province. It's just a supplement to assist you with studying. And the last thing I wanted to mention is, yes, this is meant to be universal for all 50 states, okay? So we don't go into state specific here. And technically in Canada, a lot of these concepts are also similar, because when you talk about something like beneficiaries, beneficiary is the same in either country. But I am planning to come out with Canadian version as well, okay? So first and foremost, let's get started. When you go through regular training, or when you go through the regular licensing website, it's kind of, to be honest, all over the place. And it's a little bit confusing as to, how they present the material. So Amy, what I decided to do is I said, okay, why don't we go through the material, or how do you actually do this business, right? So for example, Sam, before you can even do anything, you got to get licensed, right? And after you get licensed, then you got to know the products and services that you can offer. So you have to know generally the information. Then you can, if the client agrees, Brenda, you can fill out an application, you can submit it, you go through underwriting, and then you deliver the policy to the client, okay? So that's how I am teaching you the material today. So let's just give some general concept first about getting licensed. Every day we are flooded with information. Many offer financial advice, but they're unlicensed and without industry experience. How many of you have even seen little kids in college giving financial advice from their selfie bathroom, right? Trying to tell you about where to put your money. So nowadays there's a lot of information online, but it's not necessarily mean that they have experience or that they are licensed. So the benefits of having a license is that you are awarded this license by a governmental licensing agency. It gives you legal authority to work in this industry and this occupation, and it requires meeting predetermined criteria, such as passing a state administered exam or even going through certain background checks. So it is a great privilege to be licensed, but being licensed comes with great reward, but also comes with great responsibility, all right? So what are the things you can do once you get licensed? Okay, with a life and health license, some of the things you can offer through the WFG platform are not only life insurance, but also fixed and index annuities, disability insurance, Medicare supplement, long-term care, final expense, and through referrals, you can do personal and commercial or home, auto, and pet insurance. So Tony, don't you think it's worth it to study hard and get a license, because there's so many things that you can do, right? And we can make money doing it. Okay, so when you're properly licensed, I just want to give you a quick idea about how much money you can make when you help somebody understand financial vehicles and how you benefit as well. So let's assume you're helping somebody with one proper protection or one solution, right, of life insurance, and the annual premium is $3,000. So this is the different contract and how much you would make off of one policy or one account, okay? So let's just say even you take the middle one, which is 35% as an associate contract. Beth, How would you feel to add an extra $1,000 a month to your cash flow if you just did one a month, right? Would that help you pay off your debt faster? Would that help you save for your retirement faster or save for your kids faster? So actually, I hope you get really excited to study for this test, all right? So a most common question we get is, do we need to be licensed to recruit? Well, I want to let you know, no, you do not have to be licensed to recruit. So even though we're in studying mode right now, you can share about the opportunity when your AMA has been approved by WFG and you receive that code number. You only need to have the license when you want to talk about specific companies and products, okay? So now talking about license. So now you do want to talk about the products and services. How do you talk about it? Well, first thing is called a resident license. You're going to take your test in the place that you hold a residence or your primary place of business. Okay, so let's say, for example, for me, my primary home and I live in California. So when I take my test, I'm going to take my test in California. Okay. And if you want to share about life insurance products with someone that lives outside the state where you're licensed, you must obtain a non-resident license first. But great news, you don't have to take the license again. Okay, so I have a friend who's a lawyer, and every time he wants to get the bar in that state, Gloria, he has to take the bar exam again. Okay, and the great thing with us is that you don't have to. You just have to do an application and pay a fee, and then we can get licensed. So let's say, for example, I have family that lives in Texas. So if I want to be able to talk to them about Texas products and services, I need to apply and get a non-resident license. So a non-resident license means that you are already licensed as a resident in a specific state, and now you're seeking licensure in another state. Okay, so let's go through two examples to see if you understand this concept. You have your life and health license for California, which is where you have your primary residence. Your friend John, who lives in Utah, is coming to San Francisco to visit. He wants to see the Golden Gate Bridge. Are you eligible to speak and sell California life and health products to John? Yes or no? So could you put in the chat for me? What do you guys think? Is it yes or no? Okay. Marilyn says yes, but Anand says no. Tony says no. Some people say no. Some people say yes. So, okay, this is great. We're getting a lot of mixed answers. So let's see what the answer is. The answer is yes, you can. Okay. Why is that? Is because remember, you are licensed in California and John is in your state where you are licensed. So because he is in California with you, you are allowed to talk about California life and health products. Okay. But let's go through one other example. You only have your health and life and health license for California, which is where you have your primary residence. You are at home on a video call with your friend John, who's at his house in Utah. Can you speak to John about any life and health products? Yes or no? Okay, we're getting a lot of no's. We have Philomena said yes. Stacy said yes. So we're kind of getting like 80-20%. 80% no, 20% yes. And the answer is, everybody, no, you cannot. So remember, you have to be licensed where the client physically is. So in the first example, John is in your state physically, and you are licensed in that state. So that's why you're able to talk to him about California products and services. But physically, he is in Utah, which is where you're not licensed. So that's why you're not able to talk to him. So in that example, you would have to apply and get a non-resident license for Utah. Then after you get approved, then you can talk to John on Zoom or over the phone or whatnot. Okay. So hope that was able to clarify for you. Now, once you get licensed, there are different types of agents. And And when you're licensed, you're either called an agent or a producer. Okay. I know we like to call ourselves builders, but in the industry world, we are either called an agent or a producer. Okay. So you might see that a lot on the test. They refer to you as an agent or a producer. Okay. So the first type of agent is called a captive agent. Captive or career agents work for one insurance company and sell only that company's insurance policies. Okay. So let's say, for example, maybe Kimberly, there's a car, a brand you really, really like. So you know what? Some of you, you want that brand car. You're going to go straight to the dealership that only is the brand of that car. Does that make sense? Okay. But you could be a non-captive, okay? And a non-captive or independent agent works for themselves and they sell insurance products of multiple companies. Independent agents can represent as many companies that will appoint them. So have you ever been to a car dealership that they actually represent multiple brands in the building? Okay, so therefore, because maybe you don't know which car you want, so you can go there and you can look at many different cars. Okay, so the car salesman, you can either be a captive or you be a non-captive agent. All right, that's an example, or just some terms and definitions you'll need to know for the test. Now, another thing you need to know, you become a fiduciary when you become licensed. So as a licensed agent, you are considered a fiduciary. Fiduciary is a person in a position of trust that has financial responsibility, and you commit to not commingling your funds, and you always put the best interest of the client comes first. Okay, client comes first, not company comes first, not promotion comes first. Client comes first. That's what a fiduciary means. So how do we make sure, how do we make sure the client comes first? Okay. And then we talk about two things called suitability and affordability. Okay. Suitability means you prioritize the coverage that best fits the client. Okay. So let's say, for example, I meet Mary Lou, and I find out that Mary Lou, after she has her mortgage, her kids and everything, she needs about $2 million of coverage. Okay, but the next thing I need to consider is affordability. She needs 2 million. So, but what if she can only afford $50 a month? But I believe so much in permanent life insurance. What if I try to sell her permanent life insurance and now I get her $50 a month, but it only becomes 200,000 coverage? Then I have her affordability, but not her suitability. So we always have to make sure we're working on both. So do it right and do it with pride. Okay. So now that you understand the first part of getting licensed and the type of licenses you need and the type of agent you are, now let's go into general insurance. Okay. So what is insurance, by the way? Insurance is a transfer of risk from one party to another through a legal contract. It provides a guarantee of compensation for a specified loss, damage, illness, or death. So can you all unmute or type in the chat? What are the most common things that you buy insurance for?
A car.
Car.
Health insurance.
House.
Health.
Cell phone.
Cell phone. Pet. Okay. What about even your diamond ring? Is that true?
Yeah, jewelry.
Okay.
Yeah,
Oh, somebody
jewelry.
said electronics. That's good. Flood.
Yeah.
Okay. So, all right. Thank you, everybody. You can mute yourself again. Yes, these are probably, you recognize these cartoons. These are most common things that we insure, right? So if you ever even purchase a warranty, those are all formats of insurance. Okay. So now, when we buy insurance, how do they price that insurance, right? Like when you buy the car insurance, how do you know how much you need to buy? Or I'm sorry, how do they calculate why that premium is that way? Or when you buy the phone insurance, it's $5 a month. Why is it that way? Okay. So there is something called law of large number. Insurance is based off of the sharing of risk amongst a large group of people. The larger the number of people, the more predictable the losses are. Insurance companies use this data to calculate rates. Okay. So let's say, for example, in car insurance, when my brother wanted to get his car insurance, he wanted to get a red Toyota Prelude. And they were at 16 years old, Aldwin, they had run the numbers and they said, okay, because the car is red, it's going to be more expensive. If your brother wants it to be a black car, it could be the same exact car, but if it's black, it will be cheaper. Why? Because based off of the large number, right? Most young teenager, if they have a red car, statistically, they have more tickets than the teenager that have the same car in black. Okay, so that's an example of law of large number. So every time you buy an insurance, they are doing the law of large number of the flood insurance or the disability, your health insurance, the law of large number of your life insurance or your cell phone insurance, for example. Okay, so now what is the rating? Okay, all of these insurance companies are rated. Okay, so and the companies that rate the financial strength of the insurance companies, these are the names. Okay, so the 4 is AM Best, Fitch Rating, Standard & Poor, and Moody's. These 4 rate all the life insurance company in America. So what do you need to know for the test? You just need to remember these 4 names, okay? Because Vince, they might ask a question like this. They will say, which one is not one of the rating company? AM Best, Fitch Rating, Standard & Poor, and McDonald's. Okay, so you're gonna say there, hey, McDonald's was not on the test, right?
That's right.
Remember, it's Moody's, it's not McDonald's. So this is an example. You don't need to know more detail than this. You just need to know there's 4 rating company and the name of the 4 rating company. Okay, AM Best, Fitch Rating, Standard & Poor, and Moody's. All right. So the type of life insurance company out there, there are 4. I'm sorry, there are 2. Mutual and stock company. Okay, there's mutual and stock company. So how do you know the difference? They want you to know the difference between a mutual company versus a stock company. So a mutual company is owned by policyholders. So I try to put normal people in there, people that look like they would own policies, whereas a stock company is owned by stockholders or shareholders. So those are people that kind of sit behind desk in a very nice suit and tie, right? Insurance dividends for mutual companies, yes, they will pay out to the cash value life insurance. For stock company, no. Those dividends might go as shares or stock to the stockholders, right? And therefore, profits go to policyholders for a mutual company. And for a stock company, they go to stockholders. And because of this, a mutual company can also be called a participating company, right? That makes sense, right, everybody? Because as a policyholder, you are participating in some of the profit, but for a stock company, you are non-participating. Okay, so we are not here to argue which one's better than the other. Okay, they don't ask you which one's better than the other. In fact, it doesn't matter to them. They just want you to understand what is the difference between a mutual and a stock company for the life insurance test. Okay, now let's talk about some of the terms. So the first one is an insurer. Insurer is a company who issues an insurance policy. So in my example here, like the 3 different buildings could be 3 different insurers, okay? An insurance policy is a written contract set forth by the company. And so now you can see all these insurance companies may come out with different policies, right? In different insurance policies. So this is not on the test. We just wanted to note it so that you understand. So one insurance company can offer different types of policies, okay, depending on the suitability of the client. So for example, let's say pretend the black paper is term. So, you know, the 3 color here, black, green, and red. So one company like the blue building can offer term, universal life, and whole life. But different insurers can offer the same. So you can see this company might have a term, but this company can also offer term. Okay. So, but the main thing they want you to know for the test is what is the definition of an insurer? Is basically insurance company, or the insurance policy. Okay, is a contract. So another definition is a person. Okay. And most people, when they think of a person, right, they think, Hank, a person means a human being, an individual. Okay. But the reality is, in the insurance world, a person can be these other type of things as well. So it could be a corporation, it could be association or organization, it could be a trust, it could be a partnership. Okay. So these are all technically could be considered person or entity. So they might ask you on the text, Tamisha, which one is not a person, or which one of these are considered a person or an entity? So that's what you need to know. Okay. All right. Now, Now, those are all the type of people that can own the policy. Now let's talk about the types of life insurance. There are two types of life insurance. If we really strip down everything, there's two types of life insurance. One is term, and the second is permanent. Okay, so the main difference is the main difference between term and permanent is cash value. Okay, so it doesn't matter what letter is in front of it, whole life, universal, IUL, blah, blah, blah. Those are all permanent insurance because it has a cash value. Okay, and the difference of those is just depend how you get to interest. But if we break it down, it's just term and permanent. Now, let's talk about term first. Okay, there's three different types of term, actually. So first type of term is called decreasing term. Okay, so what is decreasing term is the death benefit actually goes down over time and the premium stays the same. Okay, so let's say, for example, if you died in year one, your beneficiary would get 200,000. But how much would you get if you died in year 15? Probably maybe 50,000. Does that make sense? Okay. So some people ask, why in the world would I want to buy something that loses value? Okay. The reason I would want to buy something, even though it loses value, is because it might actually be more affordable. Okay. It might be cheaper than most of the other terms. Why? Because maybe some people, they might want to do this for a specific item. For example, this is most commonly used for mortgages. So the other name for this is called mortgage life. Okay. The most common type of term is level term. So anytime you pass away, the death benefit will be the same or level. And therefore the premium is level. And that's what you can see in a way, the premium is typically more than the decreasing premium, right? So that's level term. And the last one is increasing term. It's not that common, but people can buy where they can every year, maybe the death benefit goes up a little bit, but because you're buying more insurance, then the premium will go up a little bit every single year as well. There's no cash value, but it's just increasing the death benefit. So decreasing, you can see the death benefit is decreasing, the premium is level. Level is the death benefit is level, the premium is level, and increasing means the death benefit is increasing and the premium is increasing. Okay. So they might want to ask you, what is the difference of these type of terms? The most common is level term. So let's now go more into detail about level term. Okay. So term is the simplest type of life insurance. Like renting an apartment, the insurance company will pay the death benefit should anything happen within the length of the term. And now all I'm showing to you is how you can buy level term. Just like rent, you can pay month to month, right? But we all know that if you do an apartment month to month, it's going to be more expensive. Is that true? So sometimes we like to sign a lease, okay? And so just like term insurance or just like signing a lease, you could buy a term period. So you can do every 5-year level term. So premium go up every 5 years. It will stay consistent for 5 years. And then after the term is over, they do the next 5 year. You can do 10-year term or 20 or 30-year term. Okay. So hopefully that helped be clear for you. So what is the advantage and disadvantage? Okay. So they just want you to understand the pro and cons so that when they ask you questions about they will ask you questions, this client wants this type of policy, which one is best for them? So that's why you need to know the advantage and disadvantage. And I have a question as an example later. So the advantage is it's low cost, relatively inexpensive. So I always say better to have something than nothing, and cover liability for a specific amount of time. Okay. The disadvantage, it's only insured because of that. You're only insured for a specific amount of time, which sometimes people change their mind later. They want longer. Policy will lapse if the premium payment is missed. Premium is wasted if you don't die within the term. And becoming uninsurable forces you to renew at high rates. And there is a cutoff. You cannot renew all the way until you're 100. There is usually a time frame that they don't allow you to renew anymore. They call a maximum age. Okay, so let's do a test question. This is real test question from those licensing exam practice question. So let's do one together. Mr. X purchased a home with a 30-year mortgage. He is concerned that if he prematurely dies, the mortgage will not be paid. Which policy best suits him? A, annual renewable term, B, 30-year decreasing term, C, 30-year increasing term, or D, 30-year level term. Can you type in the chat for me? I love that some of you already started. Thank you. Okay. So let's see what a lot of people, sorry, you're going to see me move here. You're so brave to unmute and open yourself, right? Okay. So we have a lot of B's coming in. Let's see what the answer is, everybody. Drum roll. And you are correct. 30-year decreasing term. Okay. What is the biggest hint here? The biggest hint here for the test is the word mortgage. So Nancy, if you are going to study if you're taking the license test, and because it has the word mortgage and it's saying that he wants to cover for the mortgage, that's where we got the 30-year decreasing term. Okay, great job, everybody. Now let's talk about permanent insurance, okay? So when it comes to permanent insurance, if term insurance is like renting an apartment, then permanent insurance is like owning a home. There is cash value that can potentially generate interest to help pay for higher costs of insurance as you get older. Okay, so how does permanent insurance work? Permanent insurance is that you will put in money up front, and in the beginning, even though the cost of insurance is low, but you put in that premium, the extra premium goes into this green triangle that is called cash value. That cash value grows with some interest, so that it can cover later on, even though you're putting the same amount of premium, or you maybe even depending on the policy, you can stop putting premium, but the extra money in here can cover for the extra or for the increasing cost of insurance. Okay, so let's go through now the different types of permanent insurance. Okay, so remember, all of these are permanent insurance, and which means they have cash value. The only difference, David, of what makes it, or what makes it called a W or WL, like a whole life or universal life or whatever, is how the interest is and how the flexibility or not. So let's go through whole life first. Okay, so let's go through whole life first. So whole life is a policy that you keep your whole life. Okay, part of your premium purchase insurance, which can be sold back to the life insurance company, creating cash value. So the main feature of whole life is, number one, it's lasts until 100 years old. Okay, so that's essentially your whole life, 100 years old, and it's fixed premium. Fixed premium. So you can see this line that you're putting in. You see here, let's just read, this is your premium. It's fixed. It's the same all the way into the whole policy. Okay. And then again, the money you put in, it goes into this extra cash value. It grows with interest, and that either goes to increasing cost of insurance or that you can access the cash value. Okay. What is the advantage of whole life? The advantage is that they give you a guaranteed interest rate. Okay. They give you pay schedule, like you can make a design that you can say, oh, I only want to pay for 10 years and then I want it to be paid off, or I want to be 20 years and I want to be paid off, etc. Or I want to pay it at 65 and then I'm done. So it could be designed that way, or it could, and it's a permanent policy designed to last your entire life, and it's 100. So the disadvantage is that the guaranteed interest tends to be conservative because they have to guarantee that amount no matter what happens in the world, right? Then the premium is fixed. So a lot of people concerned, oh, what if I lose my job? So the premium is fixed, you have to pay. The death benefit is also fixed, and if you access your cash value, then you start to eliminate those guarantees. Okay, so test question. An accountant has income potential for 20 years and is looking for permanent insurance. Which policy best suits them? A, 20-year decreasing term, B, 20-year inflation term, C, 20-year increasing term, or D, 20-year pay life. Please type in your answer in the chat. I'm going to give you a second to all write that down. Okay, I see a lot of you put D. Let's see what the answer is. Good job, students. It is D, 20-year pay life, okay? So for those of you that need to take the test, why is it D? What is the biggest hint here, okay? So the biggest hint is number one, it's permanent insurance, right? So you can eliminate almost 3 of the answers automatically because these are all term. And technically inflation term is not even real, okay? So, but they're just trying to use that to trick you. So the main thing here of why the answer become D is because the word permanent insurance. So here it is, you can see part of the whole life. All right, great job, everybody. Okay, so now when it comes to the policy, now they have something called non-forfeiture options. Okay, non-forfeiture option. Non-forfeiture option means that if you want to, you don't want to pay the policy anymore. So in a way, does anybody know the word forfeit? Right? Forfeit mean like you give up. Okay, so forfeit mean like you don't want to pay anymore. Non-forfeiture option, you don't want to pay anymore. What are the 3 options? The first one is called surrender for cash. Okay, so let's say, for example, Tran, you have money in the cash value. You want to surrender the policy. So how do you do it? You can do surrender for cash. And if there's extra money in the cash value of your premium, that will become taxable now because you're closing the policy, right? But let me give you a test question. A client opens a permanent policy. After 5 years, the client needs to surrender the policy. How much is the client surrender value? A, 2,500, B, 4,588, C, 0, or D, none of the above? All right, I'm getting a lot of B's. I got 1A, 1D, so all right. Let's see what the answer is. Good job if you answered B, 4,588, okay? So again, how do we get this answer? You are looking into the policy year in the question, which is 5 years, and they want to surrender for cash. So that's how we know it's 4,588, okay? Now, the second type is called paid up insurance, paid up permanent insurance, okay? What you're doing is that you would be using existing cash value to purchase smaller, fully paid up whole life policy, okay? Smaller, fully paid up whole life policy, okay? So let me give you an example. The death benefit you bought is $100,000. If the client decides to use the paid up permanent insurance option at year 20, what is the new death benefit and how long would it last? A, 100,000 and 65 years old. B, 100,000 and 100 years old. C, 63,100 and 65 years old. Or D, 63,100 and 100 years old. I should play some Jeopardy music every time the question comes up. Do, 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 do. I'm not a good singer, so I'm not going to do it. But
do we have to answer in the form of question, if that's the case? For Jeopardy. For Jeopardy.
For Jeopardy? Oh. Oh my gosh, I'm not that smart, you see. So unfortunately, no, I can't. Thank you for messing with me. Oh my gosh, I accidentally revealed the answer, but there you go. My mouse is so sensitive. The answer is D, okay? 63,100. A lot of you got it right. I'm proud of you. But now let me explain this for you, okay? Why is the answer D? So remember, even though the original death benefit was 100,000, but paid up permanent insurance is using existing cash value to purchase smaller, right? So what we're saying is that in this example, after 20 years, the client decides, I'm done paying the policy. I don't want to pay anymore. So my option is that if I want to use paid up permanent, instead of having 100,000, if I want to keep 100,000, I have to keep paying the premium. So I want to stop paying the premium. So I'm settling, right? I'm saying, okay, in exchange for not paying the premium anymore, I'm willing to settle for less amount of life insurance. But the type of policy, it stays the same. It's still a whole life. So remember how old whole life lasts until? 100 years old. Okay, so I just threw in 65 to throw you off, but that's why the answer is 63, 100, and 100 years old. I say so. Good job to you if you got D. All right, so now last one is called extended level term insurance. Okay, so the hints are kind of in the names. If you notice, surrender for cash. The second one is paid up permanent. Okay, and this one is level term, extended level term. So what you're doing is you're using the cash value to purchase paid up level term, which means for a maximum number of years and days, and the face amount must be identical. Okay, so let's see here. This client is 50 years old and wants to use the extended level term insurance option at the end of year 10. At what age will his term expire? A, 56 and 118 days. B, when he's 60 and 268 days years old. C, 68 and 72 years old. And D, 71 and 70 days years old. Okay, some of you saying, C, I got a B answer. Okay. All right, are you guys all ready for the answer? The answer is C, 68 and 72 days old. Okay, so I should have probably thrown in there the death benefit to throw you off a little bit. I might do that in my next update. But if the example, if the client bought a $100,000 policy, when you're using this option, the death benefit is still $100,000, right? Remember this clue right here? The face amount is still $100,000. The only difference is that when now, instead of having 100,000 all the way till 100, I'm willing to not pay, but just last until a certain age instead. So in the example, when I'm 50 and I want to use it at the end of year 10, so now he's 50, you have to take these 10, this year's here. 50 plus 18 is 68 and 72 days. Okay, so that's why the answer is C. All right, great job if you answered C. Now, these are the three again. Just remember the summary. Surrender for cash. So you're closing the policy, you're getting cash out. Paid up permanent insurance is you're using less life insurance, but until 100. And then level term is the same amount of coverage, but for less time because it now becomes a term. Okay, so that is a difference of the three types of forfeiture options. Okay, hope that was able to help you. Now, let's go through universal life. Okay, universal life, the main difference is that universal can also be called adjustable. Okay, it's similar to whole life. It's permanent for your entire life. However, it has flexible premium. Of course, you have to have minimum and maximum, but it also creates a flexible death benefit. So for example, it's flexible premium. So remember the first type of whole life, you saw one line that was straight the whole time because it's fixed premium, right? So Philomena, it's fixed premium. You pay the same thing the whole time. But this one is that when maybe some of you get a raise at your job and you're like, okay, Charlie, I can put in more. I'm going to put in more. But some of you, sometimes you feel financial stress. Maybe you lost a job. You want to put in less. Then universal life gives you flexibility. So anytime you see the word universal or adjustable, it means flexible. Okay. So, but same concept. Once you put the money in, that extra interest grows to help you with your cost of insurance or that you can access the cash value. What is the pros and cons? The advantage is a flexible premium, flexible death benefit. The policy and payment can be designed during the life of the contract. Permanent policy design can last you your entire life, and you have access to cash value. The disadvantage is that guaranteed interest tends to be conservative, and underfunded policies may require additional premium later in life. Because it has flexibility, and so sometimes if you have the flexibility to pay too little, then they might ask you, hey, you got to put in more because you didn't put in enough in the beginning. Okay, so that's what universal life means. So now that you understand what universal life means, then when we put a letter in front of it, then it's just sharing with you how you get the interest. So indexed universal life, okay, but also depends on the state. Some state call it equity universal life, and some states call it equity index universal life, okay? But basically both word means index, and it has a flexibility of universal life, but now the cash value gets interest based off of a market index. For example, S&P 500, okay? So they might have a floor and a cap, but really this is for the licensing test. This is not for selling and stuff like that. So all you just need to know is that IUL means that it's flexible and that the cash value is credited based off of an index, for example, S&P 500. Okay, so it's flexible premium, just like a universal life, and same concept. Okay, you can access cash value or use that for cost of insurance. What are the pros and cons? The advantage is that crediting interest gives you the ability to rise with index gains without the market risk. Flexible premium, flexible death benefit. Policy and payment can be designed during the life of the contract. Permanent policy designed to last your entire life. Access to cash value. But just like the other disadvantage, similar is that underfunded policies can require additional premium later in life. So as long as you understand, it's a great policy. Okay. So the two things that these are two different policies now that I'm going to go through with you that were not on the circles of life insurance. Okay. But I'm going to explain to you why. So first one is called variable life. The main difference is how the cash value grows. Cash value is in a separate account or a sub-account, which are in investments, stocks, bonds, or other investment vehicles. The separate account is regulated as a mutual fund by the Securities Exchange Commission, and you are able to have greater growth potential. You can get unlimited growth, but unlimited growth also comes with unlimited risk, right? So cash value and death benefit can change every day depending on the investment performance. There's no guarantee regarding the cash value, okay? But the reason why you don't really need to know that much about it is because when you have a life and health license, you cannot talk about this, right? So do they have this on the test? They do, ironically, okay? They will say, oh, is this one of the type of life insurance, or how does variable life work? So that you can go as much detail as this only. But the main thing you need to know is that you have to have a life license and a FINRA securities license, a Series 6 or 67, to even talk about variable life or variable universal life, okay? So again, what's variable universal life? Is the same policy as mentioned in the slide, except it has flexible premium and flexible death benefit, okay? So yes, it's weird. It's on the slide. It's on the test. I think they just want you to know that there are other types of insurance outside of the ones that you can sell, but they just want you to know that there are other kinds, but you can't sell it unless you are specifically licensed, and you can't talk about it unless you have these licenses, okay? So question, out of these type of insurance, which combines a savings component with a flexible premium option? A, universal life, B, 20-year pay life, C, survivorship life, or D, term life? Answers coming in quick this time. All right, we're getting a lot of A's. I got a few C's though, so let's see.
A.
The answer is A, universal life, okay? What is the biggest hint here for the answer is flexible, okay? The word flexible, remember, universal means flexible. It also means adjustable. So that's how we have this answer here. All right. Now, let's get into policy designs, okay? So life insurance can have different designs based on who is the owner, the insured, and the purpose. So one example here is called juvenile life. Juvenile life means the owner is the parent and the child is the insured, okay? So they just want you to know, what is juvenile life? The owner is the parent is the owner, and the child is the insured. Why would somebody want a policy like this? Maybe they want to start early. They want to be able to lock in, children. They don't have medical exams. So there could be many reasons why, but this is called juvenile life. Now, there's another one called joint life or survivorship life. And they sound similar because they found they have to have 2 lives to be on the policy. So what is the main difference on them? So joint life, the easiest way for you to remember is first to die. Okay. And survivorship is second to die. So let me give you an example. Joint life pays out after the first death. So you can see here, a husband and wife, they want to buy a policy together. Gus, maybe it's because if they buy individual policies, it's too much premium for them. But if they combine it, they can afford it. Okay. So they buy it together. They call joint life. But when one person passes away, then the other person receives the beneficiary or the death benefit. And now the policy's over with. Okay, the policy doesn't exist anymore because it's already done after the first person dies. Okay, so the other option is called survivorship life, or it's also known as second to die or last to die. And this one, both people that are on the policy have to pass away in order for beneficiary to get the check. Why would people want this? This is very common for estate planning. Okay, because estate taxes kicks in after both husband and wife pass away. That's when the kids pay estate taxes. So it just depends on the situation. But again, they just want you to know the difference between joint life versus survivorship life. So now you know joint life means first to die, right? Means one of them die and then the policy gets paid out and it's done. But survivorship is second to die. Both of them have to pass away. Then the policy is done and gets paid out. So now the other type is called business insurance. How do businesses use life insurance? There's 2 kinds. One is called buy sell. Okay. So business partners can use life insurance for business continuation in the event of a partner's death. So let's pretend me and Pierre, we want to go into business together. We want to open a restaurant together. I put down $1 million. Pierre puts down $1 million. Okay. But what if one of us passes away while we're building the restaurant? And, our wives are not involved, our kids are not involved, etc. Right? So we can pre-arrange a purchase price. I could say, hey, Pierre, if anything happens to you, what about I buy out your 1 million plus another 1 million for your family? So we buy a $2 million policy, for example. Okay. Death benefit will go to your beneficiary. It will go to your family, your wife, your kid, whoever you put. And now that means I paid them out for now I own the business. So it's called buy sell. Okay. The other type is key employee. This is for a business to use life insurance to offset a loss or hire a replacement due to death of a key employee. Okay, so now let's pretend me and Pierre are not partners, but now I am the business owner. I'm the one that put it down $2 million. He didn't put down anything, but he's my manager. And he's very important. He helps me run the daily operation. So if anything ever happened to him, don't you think it's going to be very stressful for me? And probably customer will slow down because it will take me time to find and train somebody new. So that is called key employee. So now the business owner owns the policy on the employee, but the beneficiary is not the family. The beneficiary is back to the business because I take that money to pay to find a new employee or to keep the business going. Okay, so the main points you want to know about the 2 type of policy is that who is the owner and the payer. In both cases, it's the business. Okay, and the insurable interest is met because of financial loss connection between both parties. Okay, that's the main thing they're going to want you to know for the 2 types of insurance, business, or for the 2 types of business insurance, buy, sell, and key employee. So another way to design policy is to use riders, okay? And people always ask me, how do I explain what a rider is? Well, how many of you ever bought a car? And did you know that you can customize a car? You can pick the paint color. You can pay more for better speaker system. Or some of you like bigger wheels, bigger rims, right? Those are all examples of customization. So just like buying a car, riders are optional features that you can add to a policy to customize your life insurance for extra costs. Okay, what are some examples of riders? So the first one is called other insured rider. Like you want to add somebody to your policy, you can add another person, you can add a spouse up until age 65, or you can add a child, and a child, they can be converted between 18 to 21. Okay, so maybe you just you don't want two separate policy, but you want one policy that you can add somebody else on there. Another one is called Guaranteed Insurability Rider. It allows you to buy more life insurance at future date without needing to take any physical exam or prove insurability. So hint, guaranteed insurability, right? So let's say what it's saying is that, you know, Ferline, you want to buy, maybe only today you can only afford 100,000, but you want the option to buy more in the future. So maybe you want to be able, you can afford only a little bit right now. You buy an extra rider every single month so that whenever the time comes, you need to buy 200,000. Now you have guaranteed insurability. It doesn't matter if your health change, you know, you will still have to buy at the new age, the cost, but they cannot decline you. Okay, so that's guaranteed insurability rider. Return of premium rider, the reason I put the hand out is because you want your money back, okay? So return of premium rider means that at the end of the contract, you get all your premium back. If you stay alive after the contract, then they're gonna give you all the money back. That's return of premium rider. Payer rider is for juvenile policies because the insured is a child, right? So they don't have control of the policy. So if you wanna add this, it's for in case the owner, like the parent, gets disabled or dies, then the premium becomes waived for the child until they become 21. Okay, and then at that rate, they can decide to take over or the policy just doesn't exist anymore. That is called a payer rider for juvenile policies. Now, a very popular rider, not popular in terms of when we design it, but popular for the test, okay? They want to test you on waiver of premium. So premiums are waived if the owner becomes, if the owner becomes disabled for more than 6 months. Dividends will still get paid out, cash value will still grow, and it expires at 65, but this is how it works. Pretend you're that guy, you broke your back and you're not able to go to work, you get disability. So for the first 6 months, though, you still pay the premium, even though you're disability. You still have to pay the premium. But if they find out that after 6 months, you're still on disability, then in the 7 months, they will pay all the 6 month premium back to you, and then they will start waiving the premium after that. Okay, so that is waiver of premium. Now they have another one called waiver of premium with disability. It is the same as waiver of premium, but they just add on that they will give you a monthly income for disability income. Okay, it usually pays 2 to 5 years, and the percentage is depending on the policy you buy. All right, so question. W has a waiver of premium with his universal life. He suffered a disability due to illness for 18 months. How many months will his premiums be waived? A, 12 months because of the waiting period. B, nothing because disability is for accidents, not illness. C, 18 months. Or D, 12 months because that's the maximum. A, B, C, or D. What do you think? I'm getting some A's. I'm getting some C's. Okay. I got a B. All right. Are you ready for the answer? The answer is C, 18 months. Okay. Remember in the previous slide, you just, as long as your disability over 6 months, then all your premiums will be waived. Okay, so that's why the answer is C, 18 months. All right, great job, most of you. Okay, last thing for riders, or no, last three riders. We have 3 more riders. This one, I want to share with you the difference between AD&D and ADB. Okay, it's kind of confusing, so that's why I want to put it on the same slide. AD&D stands for accidental death and dismemberment or dismemberment. This one is you provide additional death benefit if the cause of death is accidental. So let's say, for example, you know, Helen, I buy a policy for $100,000. If I die of cancer, it's $100,000. But if I die because I got into a car accident, they will pay me, my family, $200,000 or $300,000. Okay, so the death must occur within 90 days of the accident. The other one is called ADB, accelerated death benefit rider. This is a terminal illness rider, also known as terminal illness rider. And the it's when your doctor tells you, I'm sorry, Alicia, you only have 12 months to live. Or I'm sorry, we found out it's stage 4 cancer, you only have 6 months to live. When it gets to that point, you can receive a percentage of the death benefit in advance of death. Okay, so that is the difference of AD&D versus ADB. Let's see if you understand the difference. Question. John has type 2 diabetes. He had his right leg amputated, which is dismemberment, right? And then 7 months later, he died from the same illness. He has 100,000 life insurance plus AD&D rider with double indemnity and 20K principal sum and 10K capital sum benefit. How much will his beneficiary receive? 0, A 0, B 210, C 110, or D 100? I see B, C, D. It's 30, 30, 30. Which one is the answer? Because there's not majority on here. Interesting. Didn't you say some of you are licensed 50-50 license on here? Okay. Are you ready for the answer? I hope you're drum rolling with me and I'm not just like awkwardly doing it by myself in my room. Okay, the answer is D, 100,000. Oh, I saw Glenda's face. She got it wrong. Okay, all right. Why did you get it wrong, Glenda? Let me explain to you. What is the cause of death and the cause of the dismemberment? Diabetes. Remember,
Yeah.
B, the first letter. A is accident.
Accident. Okay.
Okay. So it has to be die or dismember from accident. So because it was from diabetes, which is not an accident, it's a health issue. So it's it confusing you because, you know, it throws in all these fancy words, right? Like it got dismembered and then principal sum, capital sum. So you guys all thought, oh my gosh, you know, whatever. I got confused. But actually, because it was health related, not accident related, then that's why it just pays out the original amount, which is 100,000. Okay, so, all right. Hopefully, you all was able to get that. You were able to get that answer. All right. Last rider is called long-term care rider. Okay, it accelerates death benefit for long-term care needs, and there's 2 ways to qualify. Either 1, you're unable to perform 2 out of the 6 activities of daily living. Okay, so these are the activities of daily living. And then, or the other way is that you suffer from cognitive impairment, such as Alzheimer's, stroke, or mental dementia. Okay, that's all you would need to know for the licensing side. Okay, is they just want you to know what is long-term care rider, how do you qualify for it? Okay, all right. So now you have finally got licensed, you've explained all the ways to the policy, you've designed the policy, and the client is ready to buy. What do? Now you got to fill out an application and start submitting it. Okay, so how do you fill out an application? Well, who are the parties of the contract? The first party of the contract is an owner or the applicant. The owner is the person who has control of the policy during the insured's lifetime. Okay, so the owner is the one that has the power to access the cash value, to surrender the policy, and change the beneficiary. Okay, so it's important for you to know that the owner is the one that has all the power. The insured is just the person whose life is being insured. Okay, and last but not least, the beneficiary is the person that's entitled to receive the death benefit of the passing of the insured. Okay, so those are the 3 parties. Now, they will talk about what is a 2-party contract. A 2-party contract is when the owner and the insured is the same person. Okay, so let's say, for example, Beth wants to buy her own policy and she wants to be the one that is the insured, then she is involved in a 2-party contract because it's only between her and the life insurance company or the insurer. It becomes a third-party contract when I want to own on somebody else's life. Okay, so for example, maybe this son who's worried about his aging mom wants to buy a policy on his mom. So now there's three-party involved. It is called a third-party contract. Okay, that is just some definition you need to know. Now, can anybody pick somebody off the street and buy them an insurance policy? Let's say, Vicky, I see an old lady and I'm like, you know what? You look like you're about to die in 6 months. I think that it's worth my money. I only have to pay a few $100s. I will get a few $100,000. You cannot just buy on anybody. Okay. So you have to have what they call insurable interest. Insurable interest is, in order to purchase insurance on a person, the owner must possess insurable interest in that person. Insurable interest is typically based on financial relationship, has to have financial relationship, and must exist at the time of application or policy issue. Okay, so let me give you some examples. Would a mom and a son have financial relationship? Yes, maybe the mom is retired, lives with the son has to take care of the mom, so he wants some life insurance on her, or if in case she gets sick or something like that, right? So that makes sense. Or the example earlier of the two business partners. Yes, we have financial relationship together because our income relies on doing business together, right? So that can be an example of insurable interest. But just because suddenly you become my downline and now I make override on you does not suddenly make me have insurable interest together. Okay, unless you are family and you're related, you might have insurable interest, but pure upline downline does not mean you have insurable interest. Okay, so question: what is the main purpose of insurable interest? Okay, A, allow someone to buy life insurance policy on any person they want. B, establish a new form of gambling. C, protect and preserve life against foul play. Or C, experience a profit if someone were to die. What is the main purpose of insurable interest? Insurable interest. I'm worried if any of you pick the answer B, I'm kind of worried of who you are. Just kidding. Okay. All right. The answer is C, to protect and preserve life against foul play. Okay. I know it's a weird question, but hey, these are real questions from the licensing companies. Okay. So preserve and protect life against foul play, right? That's why they want you to have insurable interest. Okay. So hope you guys were able to understand that. So, State Guarantee Association. A lot of people ask, what if the life insurance company goes bankrupt? Well, in a very rare case, there are state guarantee associations that act as a safety net to protect policyholders if the life insurance company that issued the annuity or insurance policy has insufficient asset and cannot meet a financial obligation. So basically, to answer this question, the easy answer is there is a state guarantee association in case the life insurance company goes bankrupt. So you don't need to know that much more about it. You just need to know the term, what is a state guarantee association? They're the safety net in case life insurance company goes bankrupt. They don't have enough money. All right. So as a licensed agent, we aid in limiting exposure to money laundering, tax evasion, and other financial crime. Some red flags that the underwriter will look for are rapid movement of funds. Okay, if they're trying to move money around really quickly. Lack of clarity regarding customers' identity. So if they're not willing to tell you that much about who they are or what their work is. Lack of clarity regarding where the funds came from, where the money came from. Inflated financials. So if they say, oh yeah, I'm a billionaire, then you can kind of see their lifestyle is not. Unrelated third parties or cash intensive business. Okay. So refusal to disclose identity or source of funds is one of the biggest red flags of financial crime. And fraud represents intentional deception. So as an example, when you write business with no intention to place in order just to receive commission, advance, or promotion, or a jacket, then that is fraud and it is illegal. Okay. And that is considered intentional deception. So make sure you guys don't do that. All right. So now that you understand all parts about submitting an application, it only starts with an application. It's just the first step. Now we have to go through something called underwriting. Okay. After underwriting's over, if they approve, then now the client gets to make a decision and the delivery. Okay. So the purpose of underwriting is to determine whether to accept the risk of the applicant and insured applying for the insurance coverage. So remember, getting approved for life insurance is a privilege. It's not a right. Even if you have all the money in the world, you can't just buy it. You have to qualify for it. So when you sign a HIPAA form, underwriters start to have access to resources such as the application, which includes an agent report and the personal interview, something called an APS, which is attending physician statements. They want to ask the opinion of the doctor, a paramed if required, which is like a blood or urine sample, medical insurance bureau or MIB, which is your health history. And then last but not least is your driving record. Okay. They might even ask your credit and stuff like that, but these are the main ones. So when they are doing underwriting, what are they looking for? Well, have anybody ever experienced that you are approved for life insurance, but denied for a rider? The reason is because underwriters have to look at two different types of statistics. One is called mortality and the other one is called morbidity. Okay. So remember I talked about the law of large number. So the mortality table is looking into the likeliness of dying. Okay. And morbidity is the likeliness of injury or illness. So let's say, for example, something like arthritis, right? Arthritis is not going to make you die right away. It's very likely that you're going to have disability. Does that make sense? Okay. So, but let's say, for example, maybe cancer, you might not be disabled, but you could pass away easily. So that's example of mortality and morbidity. And the license that we take, actually, so life insurance license allows us to do mortality products related to mortality table. And then our accident and health insurance allows us to do products and service that are based off of the morbidity table. Okay. So it's just one of the things they want you to understand is a difference of mortality and morbidity. How does this affect you? Well, life insurance carriers will group people with similar risk into categories called rate classes. So some examples are listed there, so preferred plus, preferred, etc. But they might use different names. They might use non-tobacco, or they might use preferred elite. But so it's just depending on the company, but these are examples. And then how does it affect the premium? So that is the table I have here on the right-hand side. So you can see, for example, if you're a non-smoker and you're preferred, your premium might be $368 for a 500,000 policy. But the same policy, if you are table rated, could now become $688. Okay. And then if you're a smoker, you know, it could be a lot higher. So set expectations with your client before you complete the application. You and your client should understand that the rate class quoted is not set in stone and will be ultimately be determined by the underwriter. Okay. So question. Who are the potential parties that must sign an application before underwriting can begin? A, applicant insured beneficiary, B, applicant insured agent, C, applicant beneficiary agent, or D, applicant and insured. Okay. I'm getting some B and D's. Okay. Let's see what the answer is. It is B, applicant, insured, and agent. Okay. So let's kind of go through this right here. The person applying for the policy, they have to sign because they're requesting for the policy, right? The insured. So if you cannot just say, oh, I want to buy it on my husband, but I don't want him to know. No, the insured has to know that there's a policy on him. So that's why he or she has to sign. And then the agent is the one verifying the information. They're submitting the application to the company. So that's why they have to sign too. So it takes these three people to sign the application. Okay.
Unless the insured is juvenile.
Yes, you're correct. Unless the insured is juvenile. But if the question doesn't state they're juvenile, then that's why this is the answer here. Okay. So remember, for the license test, you're trying to know the answer for the licensing, not for specifically, how do you say, like you come up with all the in case scenario, right? So that is for when we sell, but this is specifically for, if the licensing exam. Okay, so they didn't write down that it's insured, so that's why the answer is B. All right. Now, one thing when you're in underwriting, a question comes up is, what if you pass away? What if you pass away while you're in underwriting? Coverage is effective on the condition that applicant is proven to be insurable on the date of the application or medical exam. So, generally, you can be conditionally covered or have temporary coverage once these are submitted to the company. It takes three things, okay? The application, the initial premium, and the medical exam, okay? Three things, everybody. So, as an example, a healthy applicant dies suddenly while still in underwriting. If the client was conditionally covered, the insurance company would continue underwriting her application. If they would have approved her application, they would pay the claim for the beneficiary. So check with every company for their individual rules, but in general, the thing to meet conditional coverage is application, initial premium, and medical exam. Okay, so now let's go through some examples and some questions. Let's go through policy delivery because there's one more thing, and then we're going to go through examples and questions. So when you deliver the policy, there's something called a free look period. After the policy is issued, it's important for the agent to deliver the policy to the client and review all the information. Okay. Once the policy is delivered, the free look period begins. Free look is a specific window that a client can change their mind for any reason and cancel the policy without penalty and receive a refund of the initial premium. So why do all of us like to shop at Costco or at Nordstrom? Because they have a great refund policy, right? So in life insurance, it's called a free look period. So it's anywhere between 10 to 30 days. And this is going to be state specific. So please make sure, depending on where you live, you check how many days it is. But in general, for people that are over 65, for senior citizen, on all the states, it's typically a 30-day free look. Okay. But for younger than 65, please look into your individual state license so that you know what is the answer, because they will ask this on the exam. So now let's go through some quizzes. Now let's pretend January 11th, the insurance company receives application and initial premium. Okay. January 16th, insurance company receives medical exam and applicant now meets conditional or rules for conditional coverage. Insurance company approves application and issues the policy on February 22nd. And February 26th, the agent delivers the contract to the client. First question. On what day does a client qualify for conditional coverage? January 11th, January 16th, or February 22? Okay, I'm getting a mix of A and B. Okay, let's see what the answer is. It's B, January 16th. Why? Because remember, on January 11th, it's only two things, application and premium. We're missing the medical. It needs three things to apply for conditional coverage, okay? So it was here. receives medical exam, and I even wrote it down. Applicant now meets rules for conditional coverage. All right. So the answer is January 16th. On what day does a free look period begin? January 16th, February 22nd, or February 26th? Okay, I'm getting mostly C's, but I actually do see some A and B's in there. Okay, the answer is C, February 26th. Okay, remember, free look period begins when I deliver to the client. So it doesn't matter if the company approves it. The free look doesn't begin until the client receives it or until we deliver it. Okay, last one. If the client accidentally dies on February 1st, would the insurance company pay the claim? So pay attention to the dates here, right? It didn't approve yet. It was on February 1st. Would the insurance company pay the claim? Yes or no? Okay, we're getting a lot of yeses. Let's see if you're correct. Yes, they would pay. Remember why? Because even if they died here on February 1st, they would continue the underwriting, and if they saw they would have approved her, they would pay the life insurance to the beneficiary. Okay, so we have 4 or 5 slides of this, so don't think that you got it covered yet. I want to make sure I drill it and so that you really learn. January 11th, insurance company receives application, medical exam, and initial premium. January 16th, client passes away from a car accident. February 22, insurance company declines the application due to client's medical exam results and returns the initial premium. On what day does a client qualify for conditional coverage? January 11, January 16, or C, February 22? Okay, I'm getting a lot of A, so let's see. Yes, the answer is A. Good job, you're getting better because they got 3 things, right? Exam, application, and initial premium. So that's correct, January 11th. When the client accidentally dies on January 16th, does the company continue to do underwriting even though the client died? Yes or no?
Yes. Yes.
Okay, very good. The answer is yes, the company would. Why would the company continue underwriting? Because he met conditional coverage. Okay, if he did not meet conditional coverage, AYACO, then they would stop the underwriting because he didn't fulfill the minimum 3 requirement. Okay, but because he met conditional coverage, that's why they'll continue underwriting even though he passed away. When the client accidentally dies on January 16th, would the insurance company pay the claim? Yes or no?
Yes.
This one is 50-50. I see a lot of A's, a lot of B's. The
Yes.
answer is no, they wouldn't because they declined him. So remember, conditional coverage means we agree to cover you if you meet these 3 things, but the condition is that once we go through underwriting, we see we would have approved you, then we would pay out. Okay, but in this case, they declined him. Did they decline him because he died? No, they declined him because they found out maybe he has diabetes. They found out that he has family history that is very dangerous or whatever. Okay, so conditional coverage, you have to meet the 3 things. And once they go through the underwriting, they have to see if they would have approved you. Then they would only pay. But since the client didn't pass, they got declined. That's why they do not have to pay. Okay, so one more time, January 11th, insurance company receives application and initial premium. January 16th, insurance company approves and issues the policy. Just like today, right? Today, we can do the, what do you call it? Like intelligent underwriting. We don't need medical, right? So we just pay, we do the application, and we can get approved. February 22, agent delivers policy to the client. February 26, client passes away. Okay. Does the client ever qualify for conditional coverage? Yes or no? Does the client qualify for conditional coverage? Oh, I'm still getting some A's and B's, so it's 50-50. You guys are torn. Interesting. Okay, the answer is no. Remember, you need 3. You need application, medical, and premium. What does it say on that box? They only got 2. So this client never qualifies for conditional coverage. Okay, or every time we as agents do right now, intelligent underwriting with some of our partner, they do not qualify for conditional coverage. Okay. If the client accidentally passed away on January 13th, would the insurance company pay the claim? Okay, we're getting a lot more main answers now. So which means hopefully we're understanding the concept. So the answer is no. Okay, why? Because they would stop underwriting because it was not under conditional coverage. So they wouldn't even continue the underwriting anymore. Makes sense? Okay, so even though yes, they technically did end up approving, but they didn't meet conditional. So then they would never have even continued the underwriting in the first place. Okay.
If they are approving the policy, right, that means they are okay with the insurance.
But they never submitted a medical. So they don't qualify for conditional coverage.
But how did they approve it if medical is not there?
Oh, nowadays we have, even today, Transamerica Nationwide, they just approve it even without medical. They do it based on our history, right? Or all of those sources of information, our driving record, they don't need the medical.
But once you approve, once you deliver the policy, that means insurance company is saying that I'm okay with your
yes,
application.
but we are talking about conditional coverage in this question.
Okay.
We're not talking about after it gets approved. We're talking about if the person died January 16th. So you got to look at the dates. Okay.
Thank you.
Okay. So last question. When the client dies on February 26th, will the insurance company pay the claim? So this goes to answer that gentleman's question. Would they pay the claim even though he didn't have conditional coverage? Yes, he would. They would, right? So remember, approving is totally separate than conditional coverage. It's 2 different coverages. So you have to understand the difference between that. Okay? So hopefully that was able to get you all to understand. Now there's one more concept. I know it might confuse you, but I want you to understand is something called a trial application. Okay? Clients can submit an application without paying initial premium and still go through underwriting. Okay? Since no initial premium submitted, the applicant does not qualify for conditional coverage. Full coverage is effective when the policy has been issued and initial premium is collected. So life insurance companies are nice. They're willing to say, hey, you don't have to give me any money. I'll still go through underwriting if you genuinely want to take a look to see if you qualify. Okay, but you don't qualify for conditional coverage because you need the premium to qualify for conditional coverage. So this is a last sequence, okay? January 11th, insurance company receives application without premium, no premium, and underwriting begins. January 16th, applicant completes medical exam. February 22, insurance company approves and issues the policy. And February 26, client submits initial premium and agent delivers the policy. What day is the policy effective? January 16th, February 22, or February 26? What day is the policy effective?
26.
Okay, the answer is C, February 26th. That is when the policy is effective. Just because they approve doesn't mean the client didn't accept it yet. Okay.
Until they collect premium.
Yeah, they collect. Well, yeah. Oh, I'm sorry. You're correct. Until they collect premium. That's why even though it approved on the 22nd, is not effective until they collected premium on the 26th. Okay. Now, second question. If the client accidentally passed on February 23rd, would the insurance company pay the claim? Yes or no?
No.
Okay, good. Great job, everybody. No, why? Because they didn't get the money yet. Okay, so now when it comes to the test, okay, Emma, they're not going to write it in pretty little pictures like this. They're just going to give you a very long paragraph that says insurance company received on this day. Then they got the medical exam this day. So then I recommend, hopefully you use my slide, you try to make it in a little calendar on your notes or whatever, and then you try to, you think of it that way to make it more visual for you, okay? So I just made a visual to help you use the calendar, but in the life insurance test, they're just gonna write it as one super long paragraph. So you just have to learn how to visualize and to know the dates, all right? But great job, everybody, great job. Okay, so we're just down to the final concepts here. After you deliver the policy is in effect, there is still one more clause called incontestability clause. Incontestability clause is a set period, usually 2 years, to detect fraud, errors, or misstatements at the time for the application. So technically, yes, Matthew, even after the policy gets approved and delivered, they still have one more period that they can test. So they call, why do they have incontestability clause? Well, first of all, it protects the insurance company. If a client passes away within the first 2 years of the issue date, the insurance company has the right to review and investigate whether the client gave incomplete information. If the insurance company can prove that false or incomplete information was misrepresented on the application, they do not have to pay the claim. Okay, so for example, I have client that they did die after the policy was issued, but the insurance company decided not to pay because they found out that she was not honest about some of the tests on her brain, and they had proof, right? Somehow it didn't come up when they did the underwriting, but also when they asked her the question, do you have any problems? She wrote no. So she was not completely honest. So it protects the life insurance company, okay? But, so some of you say, wait, that's not fair. It's a contract we already signed. Well, it's good because it protects you too as a consumer, okay? If a client health changes and passes away, even not in the 3rd year, let's say you pass away after 6 months, but they saw that you were totally honest in your application, right? When, let's say, Melody applied, you didn't know that you were going to have diabetes or you didn't know you have cancer, then that's totally okay. If you pass away before the 2 years, if they can show that you were totally honest, they will still pay the claim. So it's fair for the insurance company. It's also fair for the client as well, okay? There is one more clause called the suicide clause, and that is not covered in the first 2 years. So, but if the client passes away before, if they kill themselves before 2 years, the life insurance company will refund all the premium to the beneficiary. So they will not pay out the life insurance, but they will refund the premium at least. Okay. If they suicide after 2 years, then they will pay the life insurance amount. They'll pay the death benefit. All right. Now, the clients had the policy and for some reason they stopped paying. What happens when the client stopped paying? First one is called grace period. It protects the insured and the policy owner for 31 days after the premium due date before the policy lapse. So in a way, maybe you change your bank and you forgot to update the life insurance company. And if you happen to pass away during that time, if you're in grace period, luckily they still protect you, they still pay out to you. Okay. However, after 31 days, then your policy lapse, then you're no longer covered. If you want coverage, you have to do something called reinstatement. Okay. Reinstatement is that if your cash value policy lapsed, you can reinstate within 3 to 5 years, but you unfortunately have to provide proof of insurability. Okay. So if something happened in your health, and not guaranteed that you get to reinstate your policy. So you provide proof of insurability, and you have to pay back the premium with interest. Okay, so check individual company or state for their requirement, but that is a difference of grace period versus reinstatement in case clients don't pay.
Excuse
If-
me, Alicia.
Yes.
All right, if the insurance lapsed, what happens to the money in the cash value of that policy? Does the insurance company keep it? Does it go back to the client? What happens?
No, the insurance company keeps that. Okay.
Got you. Thank
Yeah, no problem. Okay, so now when you pass away, let's talk about beneficiaries. Beneficiaries can be individual people, but they can also be trusts. They can be businesses. They can even be charities. Okay, so what is the order of beneficiaries? These are the names. So here you have yourself, you're the insured at the top. The first person you want to get the money is called primary beneficiary. Okay, but if for some reason those people pass away before you do, because there's a tragic accident or something like that, then who's second in line? Second in line is called contingent. Okay, second in line. And then if for some reason both of them pass away before you, then it's called third in line, is called tertiary. Okay, so all they want you to know is what is the difference between primary, contingent, and tertiary. Now, one thing we do see that they ask is something called common disaster clause. So let's say, for example, unfortunately, me and my parents were all in one car accident together. Okay, so if my parents were insured and I was a primary, but we all passed away at the same time, who the policy is going to pay to? So what the common disaster clause says is that if the insured and primary died at the same time, the insurer will use common disaster clause. They will assume the primary beneficiary died first, so that the death benefit can be paid to the contingent. Okay, so it's really easy to understand if we do the opposite. So let's say, for example, if this is my parents and this is me, and we died in the same car accident. If they pretend that my parents died first, then what happens? It will get paid to try to pay to me, but I died. So where will it go? It goes to my estate. So suddenly now it's in the sky, in the air, and my family has to fight for that through probate. Does that make sense? But if the contingent is listed and they are still alive, that's why if we died at the same time, they will pretend that I died first. So if I died first, then they know that now it has to go to the contingent. That's common disaster clause. Okay, so it's pretty common sense once you understand it. All right. Now, there's two types of beneficiary, revocable and irrevocable. Revocable, I put an unlock. Why? Because client can add or remove the beneficiary without the beneficiary consent at all. So today I'm my dad's favorite daughter. He wants to put me, but tomorrow he hates me. He wants to change it. That's totally up to him because it's a revocable beneficiary. But if he makes it an irrevocable beneficiary, this is usually used in estate planning purpose. Okay. So irrevocable, let's say client must get consent from the beneficiary before making any changes. So if my dad made me an irrevocable beneficiary and I pissed him off, he actually has to ask me my permission or my consent before making the change to somebody else. Okay, so that is the difference of revocable and irrevocable. So question, B would like to change a revocable beneficiary. Which is true? B needs to notify the beneficiary of the intent of change. B needs to call his agent and trust that they will take care of it. C, B needs to get signatures from the new beneficiary and submit it to the insurance company. Or D, B needs to fill out a change of beneficiary form and send it to the insurance company. All right, we're getting a lot of the same answers. So That means you guys are getting it. I'm a good teacher, right? Okay. The answer is D. Great job, everyone, for getting that correct. All right. So yes, remember the key word here is revocable, which means B has complete control. Okay. Revocable means we do not have to ask the beneficiary anything. So we don't have to get the editor consent. We don't have to have them to sign. The only person that signs is B. All right. Great job. So last part. This is literally the second to last slide. When it pays out, there's technically options, but most people choose lump sum. Okay. So when you pass away, they usually say, oh, I just want 100% to go to the beneficiary. But technically there are options. Okay. The license test is not going to ask you, they're not going to ask you, Glenda, what is fixed period or what is fixed amount death benefits option. They just want you to know what is the option. So they will say, okay, pretend they say lump sum, fixed period, and interest plus fixed or something. You're going to know, oh, the answer is not this one. Something like that. Okay. So I'm not going to go into detail about each of these ones because you don't need to know it for the test. You just need to know there's technically more than one option than just lump sum. Okay. So ladies and gentlemen, that concludes the life insurance portion of the licensing prep. So your next steps is to quickly finish your pre-licensing, take your test, pass it, get licensed and appointed, and let's start helping more families. All right. So I hope you were able to learn and enjoy the license.
That was awesome.
Okay.
Everybody.
Thank you, Alicia.
Awesome. Thank you.